Hey everyone, this is John Locke from lockeinyoursuccess.com, and today we have a really nice example of a lot of the theories and concepts that we teach in our Market Outlook webinars and our Trading Market Open webinars. When we do the Trading Market Open webinars, it's a really effective way to utilize zero DTE options or zero day to expiration options to make large returns in a very short period of time. So some of the concepts that we talk about. Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week. On Market Outlook, we talk about price patterns, we talk about price zones. The webinar is mainly to gain a really great understanding of price movement so that you know exactly when a good time to enter is. If you do a directional trade, for example, you know when that move goes bad on you. So it helps you to determine exit times or adding time or times when you might want to scale into a position or scale out of a position or change the position. So we had a nice trade this morning. So using those concepts. So I just kind of want to talk about that. So what we have here is we're going to do a zero data expiration trade with SPY options as our example today. And what happened is this red box here is a representation of the high from the previous trading day, which was Monday, and the low from the previous trading day. And then we have a white box here, and this white box is a representation of the futures movement in the overnight. So we had a price movement zone here, and if I take that magnitude of that price movement zone and I project it down, it provides us with what we call a price pattern target for a breakdown of the swing low. Okay, when we hit a price pattern target for the breakdown of the swing low, now this is the futures overnight all the way until 9:30, which is like right around here. When we do that, when we get that breakdown, our assumption is that we're going to run 50% of that level and we'll usually stall, and then eventually we'll come work our way down the price pattern target. And from there, we should get a market bounce. Well, we saw that occur in the overnight. Of course, you can always play this with futures or futures options if you want to do overnight trading. Our example is just simply on trading hours. So when the market opened, I'm just going to zoom in here. This is what we look like. It was at 9:30, and we got a sell-off off the open. Ideally, our entry point would be this swing low, but we don't always know it's going to get that far, right? I'm bullish for the day. We talk about this setup a lot. We get this gap down in the market, and a really high probability play is from this low down here, our price pattern target, back into the swing low of the previous day of trading. That's what we would call a very high probability trade. So on open, at about this price point, we went long on a zero DTE SPY call. I think it was a 676. So now this move to the initial move to the upside is a very high probability. As you get up into here, there's a high probability we're going to get a short-term sell-off. Where it goes from there, I don't know, right? But this move in here, particularly the move to 677, is just a very high probability move. It wouldn't have been too much of a surprise if we entered it, came back and retested here. And that would be like, for me, a scale-in point where I might even go bigger size. Of course, I always want to know what my loss numbers are because I want to make sure that I'm responsible with my losses and so forth. But I'm going to show you the way that we handled this. And I just have little circles to give you an idea of when we get in. So I get in long here on the way down off of the market open with the anticipation. So let's just talk about when we go to the analyze screen. We'll show you what we did here. So I went in long at that point, and it cost me $1.91 a contract. So on a 10 contract, that's like what, $1,910 risk in the position. So that's our total risk in the position for the total trade. I do have a plan if the market goes down. A lot of times it's actually better when the market goes down off of open because you can scale in a little bit deeper and put more money into the trade for a higher probability point for a reversal. So that's not generally an issue. But what happened here is I went long here, it sold off a little bit. It didn't, if it sold down to here, my plan was to actually roll down to the 674 and increase size. That didn't happen. It actually went our way right off. It gets up into this zone here, and I'm kind of keying into this little, looks like erroneous tick here, but a lot of times you're going to stall at that, right? So what I did there is when we got up into that point, I ended up selling the 678. What that does is it caps my profits, but it takes all my risk out of the trade. It's like if things go bad now and the SPY decides to turn around and crash out, I still make $190, right? It's not ideal, but what I'm doing is you have a couple of concepts when we're talking about risk. You have the total magnitude of risk, and then you have the total amount of time that risk is in play, right? So I've taken my risk in play in a matter of what, 2, 4, 6, 8, matter of 10 minutes, I've taken the risk out of that trade. Again, it caps me. If this thing really takes off, then so be it. But that happens. That caps me in the short term. So now I'm playing with the house's money essentially. As this continues to go, my next goal is to take more risk out of the trade. Like if this thing decides to roll back, because I'm thinking we're coming up somewhere in this range from here to this point. I mean, this would be the exact point if I'm doing precise, but I can't always hit the precise numbers, right? So I take part of the risk out. As the market decides to consolidate up here a little bit and is setting in its patterns to go higher, what I'm doing is I start taking even more risk out of the trade. So what I did here is I took this long option that I have and I sold it and I bought an option at a higher strike. So I sold the 676 and went into 677. Now, at this point, if things go bad, I still have a really good profit. $920 on $1,900 is almost 50% profit that I run off in a very short amount of time. If things keep going, that's fine. As the price continues to play out, I get up into my zone here where I believe that we're probably going to get some sort of a significant reversal in the market. So what I do there, again, I can be wrong. I can keep going. I don't know. But the important part is the wonderful part about trading this way is I can be like wrong a lot and I can be way off a lot and still make money. Like I said, we do this every Monday morning on Trading Market Open. I would say 90% of the time we come out at a profit of 50 to 100 to 200% in the time period that we're trading. And we're not even choosing days necessarily specifically. It just happens that we take whatever is given to us on Monday morning. Sometimes it's good opportunity, sometimes not. And even so, we tend to do very, very well, right? So, and we're just using all these concepts and putting them together. So here, I get up into there. I'm thinking the market's probably going to be topped out there. Like I said, I don't know for sure. But what I come in here and do at that point is I close off the other side and I run and I basically do a butterfly. So I'll come in here and I close off the other side. So now I'm locked in at like an 80% profit on the trade. And if I come back and consolidate in here, I'm playing in this zone. So now I'm playing it like an income trade. But the problem is a lot of people trade zero DTE options on an income trade, and they get hammered because if you start that way and you have a lot of risk on the table and you're sitting there and you have to expose that risk for a long time, you can take losses bigger than your potential gains, right? Here, I'm okay being in this position because worst case scenario, I make $1,570, which is like, I don't know what percentage that is. Yeah, it's like 80% of our $1,910 initial risk if you run the numbers. And this doesn't necessarily have to be the end of the trade either. If the market shifts way up here and I can get out of this at a credit of like, 85 cents, which could certainly happen, then I can either start dropping these contracts. And if I get the reversal in a day, I make more money, right? Or I could even drop all the contracts. I could drop whatever size I want. I can drop one, I can drop all 10, depending on what the pricing patterns do and so forth. In other words, this trade isn't necessarily over. The other thing that, other things that we can, look at doing is if it goes the other way, right? So I don't care which way it goes. If it goes the other way, I can, say down, I could drop out of this. It may be, a debt of say 20 cents, which would be the opposite of, getting 80 cents credit. And I can put myself into something like this to make money if it decides to go the other way. It's going to cost me a little bit, but for a small amount of extra risk, if I have high probability plays playing out within my patterns here, I could easily do 100, 150% in a day if I'm making just reasonable calls, right? They don't have to be like super accurate, and some of them can be wrong, some of them can be right. At any point, I could also just choose to reduce my size if I, if I wanted to. Right now I have a potential profit of what 1570. If I want to drop out of that, I can reduce my size down. I can pull contracts off of either side if I get some sort of a bias of which way it's going to go. If I have that, I can close the trade at a very good profit of the $1,600 range. So lots of options here. And again, I'm not like forecasting. I'm just I'm just seeing what happens with the price, looking at what the most probable stuff is likely to be, and making reasonable decisions on where I want to go with that. So I think, like I said, I just wanted to share this with you because what we do in Trading Market Open is extremely powerful. And the great part is, hey, maybe you don't want to trade zero DTE, and that's fine. I understand that, right? You don't want to necessarily be monitoring the market or feel compelled to do so. We can apply all these principles, everything that we learn in Trading Market Open, everything that we learn in Market Outlook is directly transferable to daily timeframes, to hourly timeframes, to weekly timeframes. And this can help with your long-term investments on our longer-term timeframes. It can help with your swing trades on our hourly and daily timeframes. Or if you want to take those skills and you want to put them right into zero DTE, bam, right, you can do that. So it allows you the flexibility of understanding market movement, understanding how options react, and with that understanding, you don't need like trade rules. You don't need these strict rules. You can come in here, you can have an understanding what things are doing, and you can take advantage of that, and you can do it very effectively, very high probability, very high return. So hopefully this was helpful to you guys. And if you want to see more of this, again, our Market Outlook membership or our Pro membership where we do Trading Market Open is the place to go. We do this every Monday. All right, so trade well, everybody, and we'll see you next time.